How's it going, everybody? Welcome to Fixated on Real Estate Experts Live with me, Tarl Yarber with Fixated Real Estate. We got our awesome panel every single week starting this week, Wednesday at noon. We will be doing these weekly with other experts and other specific topics just for you guys. Today, we're going to be focusing on multifamily investing, specifically the future of multifamily investing and what to do today. I have some awesome people on the panel. Literally, these guys walk on water when it comes to multifamily investing, I think, or at least that's what they tell me. So I want to welcome Mr. Brian Burke, Brian Murray, and then my not overachieving. I was going to say that. You're not overachieving at all, by the way. You're underachieving sometimes. But my incredibly best friend and super cool person in the world, Mr. Jay Scott, who's always with us on these webinars. And he has some exciting news because he just bought his first apartment complex, which we're going to talk about as well, which I'm really excited about that. Was it your first, or was it one of your first ones you syndicated?
First syndication. So we've done mid-sized multifamily, but this is the first syndication we've done, first big one.
Can't wait to hear more about it, and I'm sure with everybody else. So that said, let's jump into it. We're going to start with our panel and our bios on our panels so you guys can know who these guys are. So we're going to start with Mr. Brian Burke. Brian has been with us before on a past webinar that we've done during COVID's lockdown. And Brian is CEO of Praxis Capital. He has purchased over 3,000 apartment units, over 500 single-family homes, and raised over $100 million from investors throughout his investment career. Brian is owner of Praxis Capital and is a very active contributor for Bigger Pockets. You can learn more about Brian on Bigger Pockets podcast via number 3, the third podcast, 76 and 152. And have you gotten any recent ones as well, or?
Yeah, I think it's 378 or something like that.
Yeah. And did you just release a book?
Yes, sir. The Hands-Off Investor through Bigger Pockets.
Hands-Off Investor through biggerpockets.com. So check him out. He's an author, a legend in the making. So we also have Brian Murray. This is going to be a fun webinar because I got Brian and Brian. So we call BB and BM or whatever. I don't know what we want to say. But Brian Murray, a.k.a. Crushing It Brian. And you can follow him on Instagram. I think it is Crushing It Brian on Instagram, right?
That's right.
Awesome. Yeah, because he wrote a book called Crushing It in Apartments and Commercial Real Estate. So Brian Murray acquired his first reinvestment property in 2007 without raising any capital. Brian bootstrapped his way from newbie investor to founder and CEO of Washington Street Properties, a commercial real estate investment company that has been ranked in the Inc. 500 list and the nation's fastest growing private companies for 5 years. Brian is also the key principal and asset manager for Open Door Capital, a real estate investment firm founded by Brandon Turner that helps clients achieve superior returns through acquisitions and value-add mobile home communities. If you guys follow Brandon Turner on Instagram or anything he does, he's talking about mobile home parks a lot. Well, Brian Murray is the wizard behind the curtain, making sure those things actually work. It's not Brandon Turner. No, I'm joking. But anyways, Brandon Turner is awesome. So in 2015, Brian Murray's achievements were recognized nationally when he was presented with the Gold Stevie Award for Executive of the Year in the real estate industry. Brian is also author of the best-selling and award-winning book, Crushing It in Apartments and Commercial Real Estate. Welcome, Mr. Brian Murray, and also my fellow Maui Mastermind graduate that we went to last year. We would have done that this year, but so we don't want to be locked in for 2 weeks in a hotel room. And last but certainly not least, my best friend, Mr. Jay Scott, CEO and author. He's with 123 Flip, and he's an author and Bigger Pockets podcast for business podcast for Bigger Pockets. He's an entrepreneur, technologist, investor, and advisor, host of the Bigger Pockets Business Podcast, author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs, the book on negotiating real estate, and recession-proof investing, a timely novel. Real estate investors he's a real estate investor that's completed over 400 deals since 2008, including flips, buy and holds, now a syndication with multifamily, notes, lending, development, new construction, all sorts of great stuff. Jack of all trades, master to all of them, Mr. Jay Scott. So,
wow, you're too kind.
I know.
But I'll take it. I'll take it.
Yeah. If you guys want to be Tarl Yarber on Company Fixated Real Estate, check us out on Fixated RE Instagram and also my personal Instagram, Tarl Yarber. We're going to jump into it. So if you guys have joined us before in past webinars, the past one we've done is about the market, what was going on. A lot of squirrely stuff was happening in March, April, May, and we were doing these every other week for you guys. Now we're going to get market specific, and we're going to focus today specifically on multifamily. A lot of you guys have asked questions already in advance, and we're going to dive into those with the panelists today. And we're going to go deep, right? We're going to also talk about some nuts and bolts, not just the global economy situation. We're going to get nuts and bolts on multifamily. to start with, I want to get an update. Since Brian Burke has been with us in a prior webinar, I want to get an update from him, because when he was with us before, we didn't really know what the hell was going on in the economy with multifamily, what might be projectedly happening. We thought maybe rents might, we might have issues with collecting rents, but then we didn't. So based off of current market affairs, can you give us any idea right now, Brian Burke, what the heck's going on with multifamily today, what you've experienced, and was it as bad as you thought it was going to be, or do you think it's going to be with what happened with COVID?
Well, when COVID first happened, everybody was really afraid that that there was going to be complete chaos and a catastrophe in the real estate industry. Some were predicting, major market drops and that sort of stuff. So far, none of that has happened. And so, people have asked me, when's the other shoe going to drop? And my response has been pretty consistently that no shoe has yet dropped. So the first shoe hasn't even dropped, let alone the second one. I think some of that is still ahead of us in our future. In our portfolio, we've found our Class A and B properties are actually collecting month-over-month records, quarter-over-quarter records, even into the COVID crisis. We're finding our Class Cs definitely struggling a lot more than the A and B product. We're seeing either flat in the Class C sector or even slight declines. I have a feeling that's about to get worse. It's the NMHC, the National Multi-Housing Council, has been putting out rent collection indexes each month, talking about what collections look like, in the multifamily industry. And in past months, we've seen that index in the very high 90s around this time of the month. They just released, I think it was today, it came out at 78%, which is the lowest since the COVID crisis hit. And it stands to reason, because prior to the end of last month, there was a massive stimulus in the economy where there was $600 a week of bonus unemployment. There were $1,200 stimulus checks, and all those things really helped landlords a lot. Well, now that's all come to an end as of today anyway, and that might impact collections going forward. So I'm a little concerned about how August is going to look. It's too soon for us to know how it shakes out yet, but I am definitely a little concerned about it. But I'm even more concerned about September, given that people might not have run out of cash yet for August, but by September they may. So it'll be interesting to see what happens. I don't think it's going to be a massive reset like we saw in 2008, but I definitely think there's going to be some pain, even in the multifamily sector is going to feel it a little bit.
Great input. And then Brian Murray, do you have anything to add to that before we continue on?
No, I think what we're seeing is very consistent. I think maybe we're down maybe 2 to 3% collection wise in both apartments and mobile home parks, but it's been very resilient, and we're pretty pleased with how things are going.
That's good to hear. All right. So, well, now that's today. Right now it's like, all right, cool. Everything's cool. But we also got to think about the future. So, Brian Murray, is there anything that, with what you know now, with what's happening on and some of the stuff that Brian Burke had just mentioned, have you been changing any of your strategies in multifamily? Have you done anything different since the crisis? And are you going to continue to do things differently going forward? Can you give us an update on that?
Yeah, so we're kind of attacking this on multiple fronts, right? So we have selectively sold a few properties, but we've also been very aggressive still with our buying. We're super excited about the debt that's available out there right now. The rates are at historic lows. We actually put 5 mobile home parks under contract right around the time that fear was near its peak, and we didn't see the competition at that point. There's still a lot of buyers on the sidelines. Now, activity and competition for the properties has turned right back around and is right as high as it was before this all started. But we're still looking for deals, and we're still buying, and with debt, the kind of debt that you can lock in right now, like, we feel pretty good going in. Now, we wouldn't be as comfortable putting ourselves in a situation where we know we're going to have to refinance in a few years, but if we can find a property that's cash flowing well and lock in debt for 10 years, we're all about it.
So we'll definitely jump into the funding side a bit more later in this, because that is definitely a factor right now. I mean, rates are as low as they've ever been. And I would love to talk a little bit more economic on that with Jay Scott too, for some projections as far as rates are concerned. So Brian Burke, I have to clarify, Brian Burke, as far as for your strategies right now in real estate and your investment properties, we had a chat yesterday and you mentioned that you're doing a few things a little differently, potentially even on the acquisition side. Can you explain that a little bit more to everybody else?
Yeah, we're doing a lot of things differently. One is we're selling a lot. We sold one property and closed on March 20th, which was like getting out. You know, I kind of look at like I can still hear the band playing on the bow of the Titanic as it was sinking below the surface, is how I felt. So it was kind of cool to slough off a few assets and lock in some gains. So that's been one strategy shift, is a little bit more on the.
I want to stop you for a second because this like Brian Murray said this already. Oh yeah, we sold some of our properties. Now you've said, oh yeah, we sold some of our properties. Jay Scott bought a property. So who's buying your properties? Like if you're like, you just said like, oh, the Titanic's sinking, let's get rid of these things. Somebody bought it, right? And you probably sold it for a decent price or else you might not have sold it. But why would somebody buy the property? And why would you sell it? Because I hear that too from like in single family. That's what I specialize in. When I don't want a property or when I want to pass it off to somebody else, I get everybody in the world be like, well, if you don't want it, why should I buy it? And so who's buying your guys' properties? Why would somebody buy it now?
There's always a buyer out there somewhere, Tarl. And you know, our
Jay
buyers,
Scott.
we've bought or we've sold two this year, actually three this year. One of them is to a private investor. Another one is to a 1031 buyer, and another was to a relatively inexperienced syndicator. So there's a variety of motivations. You know, the inexperienced syndicator is looking like, hey, I can get into the syndication business and, you know, raise money from other people. That's his motivation. The 1031 buyer is letting the tax tail wag the investment dog. And the private investor just thought he had recognized a good opportunity. So there's a variety of buyers. You know, it's nothing trades without a buyer, right? And having said that, I'm a buyer too. And, you know, although since March, I've been sitting on the sidelines a lot more than being very active. We've been underwriting a lot of stuff. Can't get anything to work using the assumptions that we're using because, as you alluded to, Tara, we've changed the way we look at an acquisition a lot from what we would have done in February, for example. And that is, you know, now we're looking at 0% rent growth for 1 to 2 years. We're looking at higher bad debt loss, higher concessions, higher vacancy, net rental income declines, lower year one income than trailing 12 or annualized trailing 3 even. You know, we're only looking at really good, strong neighborhoods with good schools, good incomes, low crime, just being very, very selective in what we're willing to take on. Because, you know, our goal is just to make sure that, you know, if we find a good opportunity now that it's gonna, we're gonna be able to ride the wave all the way to the next market cycle peak.
So you basically just add in a lot more conservative criteria to your buying right now and buying what makes sense based on that, like traditionally, and being more conservative than ever, it sounds like.
Yeah, and I was conservative before, but now we're so conservative that, you know, nothing pencils. And I'm fine with that. You know, we don't have to buy anything. We only buy stuff that makes sense. So, you know, the problem is there's a bid-ask spread. Sellers are saying, geez, my property is collecting the same as it was collecting in February, maybe even more, so my value hasn't declined. What they fail to recognize is that your collections and a price per unit is not really what drives it. What drives the market is investment return. And investment return is a function of rent growth, how far you can push rents post-renovation, if you can renovate at all, where the rent comps are. And that kind of future stuff, that's what drives cap rates. So what you're seeing is a cap rate decompression is what's happening and what's causing prices to adjust.
So, all right, I want to jump into Jay really quick and pick on him a bit. You guys recently bought a multifamily. How many units?
So just to clarify, when you say you guys, I am probably the least experienced person on the team that is buying. It's a syndication led by Ashley Wilson, who
Awesome
somebody
lady.
I've been working with for a few years. She's fantastic, and we just have a tremendously strong team behind us. I'm not going to rattle off any names because I'll miss somebody and feel bad, but we've just got a great team behind us. And it's a deal that we're closing in a few weeks. It's 150 units, about 20 million. We'll put about 3 million in CapEx in over the next couple of years.
Got it. And what motivated you guys to buy that deal today, despite the crisis and so forth?
So we've been looking for deals for about 18 months. And this was a deal that we actually had under contract back in January. We were getting ready to start our due diligence at the end of February and literally had our plane tickets booked, and then COVID hit. And literally the morning that we were supposed to fly out and start due diligence, we decided to back out. Mm-hmm. Didn't do anything for about 3 months. The seller came back to us a couple months later. He was very motivated. He's a Canadian citizen. He's concerned about our currency and wanted to do basically a currency arbitrage and get rid of it as quickly as possible. So we negotiated about 11% discount off the original price that we had. And even all of our conservative estimates, we kind of checked all the boxes and decided it was still a good deal. So one, it's a B-class property in an A-class neighborhood, which we love. We're buying it entry cap rate at 6%. So even if with COVID, we can't do any repairs for another year or two, I mean, we're still generating cash enough that our investors may see a small return. Worst case, I mean, we're projecting, I mean, as Brian said, cap rate decompression. I mean, market there is, we're in Houston, market there is about 4.75%, even with a 10 basis point decompression per year. That puts us in 5 or 10 years at no more than 5.75% cap rate exit. We're projecting 6%. So we're being conservative there. We're seeing it's a strong market. We're seeing employment growth, at least up until COVID. There's been wage growth up until COVID. It's a very diverse employment base. They're large units. A lot of people are looking for larger units. So that was a big thing for us. And there's just a lot of opportunity for increases. So worst case, we're projecting a 5-year exit. But if we have to hold it for 6, 7, 8, 9, 10 years, I don't think that what we're seeing now is going to be a 10-year crisis. It could be a 3-year crisis. It could be a 5-year crisis. But even with our most conservative projections, say it again.
It could be a forever crisis.
It could be, but then we have other issues to worry about.
Yes, absolutely.
So we're being very conservative, and I agree with Brian that right now may not be the best time in history to be buying, but there are certainly opportunities out there. And what I've seen is that we're across multifamily, single family, commercial, everything. It's a very inefficient market. So you can be both. You can see both. Things going for well over what would be considered market value at the same time that you're seeing things go well under market value. If you can find the right seller and the right deal and the right circumstances, now can be a great time to buy or sell.
So on the topic of acquisitions then, and Jay, you rattled off a bunch of different criteria for why you guys are buying this particular acquisition. And with that said, Brian, if somebody's looking into multifamily for the first time, or even somebody that's in it right now, like, what are some indicators that they should be looking for, like as far as the local economies are concerned, different aspects for the units themselves that might encourage you to go like, this is a good area to invest, or this is a good unit to buy, or a good property to buy in some way? What is it that you guys are looking for? Because I know value-wise is all about the actual return and your net operating income and all that great stuff, but there's more to it than just numbers, correct? Or is it? Brian. Brian Murray, you go first. You wrote a book on it. Right. You wrote the first book, so you get to say it. So.
Yeah, sure. I'll jump in. I don't think there's no really perfect time for anybody to jump in who's brand new, right? So there could be advantages to jumping in a time like this. If you can make it work now, right, you can make it work anytime. I think if someone does their due diligence and they're careful about what they're buying, the key is you want to buy right. And actually, to be honest, you want to do that all the time. All right. So just because we're in a pandemic, it really doesn't change things. You want to make sure a property will cash flow, and you want to make sure that, you're getting good debt in place. I'm probably more optimistic about stepping in right now. Like we are aggressively buying. We've got a lot of parks under contract. We're doing careful due diligence. We're finding deals that have significant loss to lease that we can raise rents up to current market levels. We're running test ads and really validating all of our assumptions. And I think if someone does their homework and dives in and really understands a property, understands a market, that you can make a property work now. And there's a lot of people on the sidelines. I think it varies market to market. I think Jay brought up a really good point that you've got this really odd time in history where you've got this big divergence where you can find properties that are overpriced and you can find properties that are underpriced, and there's really that creates opportunity, right? And we're seeing that. Like we see a lot of properties that are overpriced. We see a lot of owners who have these terribly high expectations, but when we look at enough deals, we're still finding great opportunities at the same time. And particularly, we put a couple off-market deals under contract, and we're still excited about it. So still buying.
So okay, so thank you for sharing all that, Brian Murray. I have a specific question then. Like I live in Seattle, Washington, right, or just outside of Seattle. Multifamily sucks to buy in Seattle just because it's so hard to cash flow. It's so expensive. I mean, you buy it at like a 1 cap, or it's like 4 or whatever, but it depends. And so I'll look for small multi. Like Tacoma, Washington is just south of us. It's the fastest, most appreciating market. At least it was. One of the past reports that came out has been going out for a while, specifically also in single family. We're renting stuff out for stupid prices down there right now, but buying new acquisitions is getting harder and harder and harder to find anything that pencils at all. Even for what I do is mostly single family. So I got myself looking for out of state investments now. I'm not a tree. I don't have roots. I can go other places if I need to and still live here if I want. And I know Brian Burke, you're invested in multiple states. You live in California. You live in one of the most expensive areas of California, in the Bay Area. And so if I'm looking for something that's not in my market, what should I be looking for another market that might say, yeah, I should probably invest in this area, or it's a good chance that I am not going to risk myself as long-term in it, just because there's a lot of stuff in the middle of the US that like, oh, I could buy it cheap. It looks good, but that doesn't mean it's a great investment. Like, so what do you look for out of state or in other markets before you jump into something? Brian Burke.
I look for population trends. What I want to see is I want to see a market where people are moving to, not a market where people are moving from. I want to see markets where there's job growth and income growth. And of course, in a time like this, job growth and income growth can be somewhat elusive. But I look at pre-COVID job growth, where companies are relocating to, where factories are opening, where Amazon distribution centers are opening, all that kind of stuff. Where are they hiring and where are people moving? And good examples are people are flocking out of California and into places like Arizona and Texas. People are leaving New York and they're moving to areas like Florida, the Carolinas, Georgia. They're moving out of the kind of Midwest Rust Belt markets and moving south into Texas, Carolinas, Tennessee. So those are the places where I want to be investing. I want to be where the trend is going. Kind of like, wasn't there some kind of hockey guy or something that said, I skate to where the puck is going, not where it's been. And that's what this is. So, so one other thing, we're looking at is post-COVID rent growth. Where are there markets where, the economists are forecasting strong post-COVID rent growth? And we're looking really heavily at markets like that.
I'm going to throw in one more because obviously Brian hit the big 3: population growth, employment growth, and wage growth. I mean, if you have those 3 things, you're probably going to see rent growth over the longer term. The one I would add now, especially in an uncertain economy, is employment diversity. So don't invest. I should not say don't. I don't want to invest in a place where the entire economy is based on one industry or one large industry player. Employment diversity is really important because, as we've seen with COVID, you never know which industries might get hit by a black swan event, and that can destroy an entire portfolio if you've basically made a big bet in an area that has a single industry or a single big employer.
That's a good point. And so go ahead. Were you gonna say something, Brandon?
Oh, I was going to add one other thing as well, which is, the properties that we've been selling are in New York, and at least one factor behind that is the landlord-tenant laws. So I think the political climate is another factor to consider. If you're going to open it up to the whole country and start to say, what are some markets we should be considering? Because we look at all those things as well, but landlord-tenant laws and the political climate and those trends are another factor that's been weighing more heavily in our investment decisions.
Well, I got to bring up, since you guys have all kind of brought up also employment, right? And what is the industry in that area? What about unemployment right now? And we haven't really seen the true effects of what unemployment has done to the economy, right? And there's a lot of people that are still laid off, and they're market specific or industry specific is probably the better word. We had a gentleman, Rick Sharga, on here a little while ago, that he's known as the foreclosure expert. Like, he is brought on to CNN, Fox, all that great stuff when it comes to foreclosures on a regular basis. And he's like, I don't think we're going to see as many REOs as people think, because most of the people that are unemployed are renters, right? And at least that's one of his, the key economic indicators that he's saying there is. I don't know if that's true or not, like, because I didn't look it up, but he said that. And so I thought, okay, well, what about all this unemployment? If the stimulus checks stop, right? A lot of people rent that might be in the service industry and so forth. Will that affect certain markets, or will that affect multifamily more, or is that to come here soon because of unemployment? Or what are you guys' thoughts on that?
Well, the unemployed renter's landlord might be the one that's in foreclosure if this keeps up much longer and they keep up with these eviction moratoriums. So there could still be a supply of foreclosures, despite the fact that the service sector and the renter population might be the hardest hit. I think
that might be state specific, though, because of eviction laws and so forth, or county specific or city specific.
It might be. Yeah, it might be. But I think unemployment, of course, has to play a role, but it's part of the reason why, we're being so cautious right now. And I think if you're going to buy something in a climate such as this, you'll do yourself a lot of favors by being very conservative in the way you leverage the property. The more you borrow, the more you put yourself at risk of income disruptions, putting you into negative cash flow, or you can't service your own debt. Those are going to be where you're going to see foreclosures in the landlord space. It's from people who didn't heed that advice. I've bought several large multifamily apartment complexes from banks in foreclosure, and in every case, it was the same story where the borrower borrowed too much against the property, and that's how they ended up where they were.
I was talking when we were doing this a few months ago, when COVID first started. I think my general sentiment then was, for the next few months, all bets are off. Basically, we're in an artificial economy with stimulus, with just free money going out. And once things started to open up, and at that point I said probably early this summer, we would see kind of a normalization of the economy. And the question would be, where does that normalization occur? And my prediction, I'll call it a guess, because that's all we can really do. My guess at the time was that we'd kind of settle in at a typical recession type place. We'd see GDP negative 1 or 2%. We'd see unemployment 8, 9, 10%. And here we are in August, 6 months later, and we're still in that artificial economy. And we still haven't seen an opening up, and we're still seeing stimulus. We're still seeing the Fed buying corporate bonds. We're still seeing free money going out. And so I think at this point, everything is still kind of in wait and see mode for when the economy opens up. And will that be in a couple months? Will it be after the election? Will it be next year when there's a vaccine? Who knows? But at some point, things are going to open up, and we're going to settle in at some place. We're either going to settle in a relatively strong economy, like closer to what it was a few months ago. We're going to settle in at a typical recessionary type numbers, or we're going to settle in at something much, much worse. And where we settle in is kind of anybody's guess, but make that guess, and that kind of gives you an idea of what to expect next. And so I'm still gonna go with the guess that we're gonna settle in at typical recessionary numbers of negative GDP growth in the small numbers, unemployment 8, 9, 10%. It's gonna look like a typical recession.
I mean, I guess it's like we all, there's a lot of people here on this webinar, and myself, we all want that magic ball to say like, all right, well, hey, Jay Scott, tell us what's going to happen. So that way we can make some, educated decisions here. And the challenge is just like anytime you're investing at any time in the economy, at any moment, it's always educated guesses. Like at the end of the day, you're betting in some fashion, but you're doing it in a really smart, hopefully low risk tolerant way. This just happens to be like, there's a lot more chips on the table, or not just chips, sorry. There's a lot more unknown risk out there, right? This seems to be a little different than our usual, is the market going to go up or down? And I think that's one of the concerns. Most of the people maybe watching this right now is like, what the hell do we do, right?
And the other thing is it's complicated because the economy isn't always necessarily going to be predictive of the real estate market. Mm-hmm. We've seen plenty of recessions over the past 100 years where real estate didn't take a hit. 2008, real estate took a big hit. Early 90s, real estate took a big hit. But a lot of other recessions, real estate hasn't taken a big hit. So the question is, even if we see a recession, even if we see a major recession, doesn't necessarily mean that real estate's going to take a hit. And the things that drive real estate more are things like inflation and interest rates. And those are wild cards as well moving forward.
You heard it from Jay. Buy as much real estate as possible. No, I'm joking. Wait. So we're gonna start shifting gears here soon, guys. We're gonna start getting into, you guys have started asking a lot of questions on the Q&A. We have a lot of other questions that we pre-screened before this. We're gonna start getting into some of the nuts and bolts. So for some of you guys that are savvy investors in multifamily already, we're gonna dive into some more strategies. And for those of you guys just starting out that want to get into it, like me, myself, then we're gonna get into some nuts and bolts strategies, including like, how do you really look for a property? How do you fund it? Funding's a great question right now, because if you would have been on this webinar a few weeks ago, we'd be like, nobody's funding anything, right? And now all of a sudden everybody is back to funding. So how do you take advantage of that too? Before we do that, we're going to take a quick break and show you guys, all three of these guys, actually all four of us, are going to be at an event September 18th, 19th virtually, called the Virtual Big Badass Real Estate Wealth Expo. If you guys want to hear more from those guys in more detail, definitely be there. Go to badassexpo.com or pnwrealestateexpo.com. And we also have about 40 plus other speakers, including a lot of the contributors from Bigger Pockets that you guys are familiar with. So we're going to show you guys a very quick video about what that is all about, and we will be jumping right back on.
Hey everybody, I'm Charles Yarber with Fixated Real Estate, and I'm here to talk to you guys today about the virtual Big Badass Real Estate Wealth Expo happening this year, September 18th and 19th. Now, despite world challenges, typically this event would be the 4th year running and being the largest real estate investor conference on the entire West Coast. But we're not just going to sit on the sidelines and let the world pass us by. We're going to take this thing to the next level and make it the best virtual real estate investor conference that anybody has ever been to this year. Whether you're new to real estate or have been crushing it for years, this event is for you. We're going to have over 40 plus real estate investors that are actually kicking ass in real estate, showing you exactly how they're doing it. We're going to have plenty of exhibitors, people that specialize in the different portions of this industry that can help you take your business to the next level. We're going to have a virtual exhibit hall that you can jump around into, interact one-on-one with other exhibitors, other resources that you need to build your real estate business. Whether you're investing in multifamily, investing in single family, whether you want to learn something about real estate investing to begin with, you're going to be able to do that at this event. You're not going to just be text messaging people and be on some Slack line. You're going to be actually being able to set up your own virtual meetup with other people using our community boards and the technology that we're bringing to you for this event. You can jump around. You can meet people from different states. You can specialize and talk to people specifically with fix and flip, single family, multifamily, raising capital. It doesn't matter. You can find them to help you take your business to the next level. And you can also watch the speakers. You can watch their presentations and you can learn as much as you need to about real estate. And if you miss all those things, you get all the recordings because you buy your ticket today. Now, if you're sitting there wondering what the future of real estate holds, know this: the world is going through massive change, and there is huge opportunity for people that are prepared for what is next. This event will give you the knowledge, the tools, and the connections that you need to be able to take advantage of that next huge opportunity. So go to pnwrealestateexpo.com and get your tickets today. If you get your tickets today, we got a lineup of bonuses for you. So go to pnwrealestateexpo.com. Last note, if you've ever been to one of our events before, you know we're all about giving back. So this year, a portion of every ticket sale is going to support recalibrated veterans with the Travis Mills Foundation. So go to pnwrealestateexpo.com and get your tickets today, and we'll see you September 18th, 19th, virtually worldwide. And we got cool shirts. And I'm on a ropes course.
Oh, I love that guy. He is so funny. Ha ha. Anyways. All right. So definitely go to pnwrealestateexpo.com. Tickets are on sale right now, September 18th, 19th. All these guys will be on here, plus some of your favorite contributors for Bigger Pockets, and also some people you may not know who are kicking ass in real estate right now. We're going to dive deep into a lot of topics and interact and network with thousands of other investors. So we'll see you guys there. All right, we're back. Jumping in. So let's get into some of these questions some of you guys are asking. We are going, actually, I want to ask one other question. You kind of touched on it earlier, but okay, I want to start out in multifamily, right? I have properties I can 1031, I can raise capital, like we can go, take advantage of some of these cheap ass funding that's out there. What is a piece of advice you can give somebody that is wanting to jump into multifamily today that you would love to give? Like basically, what's the best advice you can give somebody just starting out in multifamily right now?
How big multifamily?
Well, all right. Well, that's a good question too. Should we do small multi or large multi? Like there's pluses and minuses between the two. My instinct is the largest multi I have is a triplex, right? So, I'll go to 8plex. That's the next step, right? Or is it better for me to go to a 50 or a 60 or 100 and or jump, overboard and go to 200 units? Like I don't know. What's the answer to that?
Well, as the new person here in this industry, I guess, my take is the big question you should be asking is, whose money are you risking? If you're risking your own money, that's a lot different than if you're risking somebody else's money. And so we've done mid-sized multifamily up to about 40 units on our own, just kind of seat of our pants, figuring out as we were going along, learned a lot of lessons, made some money, and wasn't too much risk. Now that we're jumping into our first deal that we're syndicating and using other people's money, that's a whole lot different. And my take there is, if you're going to be putting somebody else's money at risk, find somebody that's done it before and partner or get mentored or whatever it takes to have somebody that's experienced to walk you through it. Because what I'm finding is there's a big difference between single family and duplexes and 40 units, but there's a whole world of difference between 40 units and 100 unit plus syndications where just there's just a lot more variables.
What if I don't have any money? Like, can I get started with the low money down, like Brandon Turner says?
I just want to call attention to something that Jay said.
Oh, okay.
He said, as the new guy, he started out his comment with, as the new guy. Remember, this is a guy that's done 500 real estate deals, calling himself the new guy. And he's also done 40 unit deals. He's done multi-small unit deals on his own before doing this syndication. The important distinction there is, if this is your first real estate deal and you think you're going to go buy a 500 unit apartment complex, please think again. If you're standing on the ground and you want to get on the roof, if you try to jump from the ground to the roof, you will just break your leg. If you get on a ladder and you go one rung at a time, you'll eventually make it onto the roof. And that's what he did. And that's also what I did. I did houses and then duplexes and then fourplexes and then a 16 unit and then a 60 unit and then a 90 unit and then, multi-hundred units. So it's important that people work their way into this business and don't try to just say, well, I'm going to go raise a bunch of money from someone else, put their money at risk and go buy something way bigger than I've ever done in the past. That's just a recipe for failure, but not your own failure, a failure by losing your trusted investors' money, and they took a risk on you and they shouldn't have. This is not syndication. And so to your question, Tarl, if I have no money, can I go out and buy real estate? Yes, you can. I can attest to that because that's how I started. I literally didn't have a dime to my name when I started investing in real estate, but my first property that I bought was very inexpensive and I had seller financing and all this stuff to get into it. I learned, I screwed up, I learned from my mistakes and tried to do better the next time, and rinse and repeat and repeat and repeat and repeat. And I don't even know how many hundreds of deals I'd done before I'd done my first multifamily deal. So it's important that people don't think that syndication is a way to get into large deals with your own money and no experience, because you can not only find yourself losing your investors' money, you could find yourself in prison. This isn't something to mess with. This is a serious business, and you need to take it as seriously as it is.
Yeah, but I'm not going to sell a seminar that says your road to riches in 20 years or less.
Right? You won't sell a single copy. You won't sell a single copy. And that's why, because I have nothing to sell you, I can tell you the truth. If I was a seminar guru, I would be saying a much different story.
Yeah. So yeah, and that's true. I mean, like there's a lot of people out there that bought seminars for syndication, and that's what they hear. They hear you raise capital, make your tips, which is your commissions or fees for raising the syndication fund, and go find an operator to run it, and you're good to go, right?
Well, let's look at it. I mean, Brandon Turner. Brandon Turner's one of the smartest guys we all know. I mean, he's super successful. He's done a ton of stuff. And when he went to start a mobile home fund, what did he do? He found Brian Murray. Because these things are hard, and finding somebody that has a lot of experience that's done these things that can mentor you and walk you through and be the face or maybe not the face, but be the brains. And I'm not saying Brandon doesn't have brains, but Brandon was smart enough to realize that doing large deals is a lot different than doing small deals. And that's so my recommendation is exactly what Brian said. Find somebody that has done it and get them to help you.
You did, Jay. You didn't do this on your own. You brought in other people that had experience. They're backing you on your team. I did the same thing. You know, the executives on my team have 100,000 units of multifamily experience. It's like, you don't try to tackle it on your own, especially if it's in the beginning of your career.
You'd be amazed at the stupid questions I'm still asking people on my team daily, because this is all new to me. I mean, as many deals as I've done, in an apartment complex, a large apartment complex, there are moving parts that I never even imagined. And so again, if I didn't have hundreds of single family deals and small multifamily deals, I'd be a whole lot more lost, but I'm already lost.
Who is this Brian Murray that you speak of? He sounds so wise and knowledgeable in real estate. And so, I mean, Brian, what are your thoughts on, all right, so somebody's starting out, right?
Yeah.
And they want to get started. All right, you can forget the whole no money down thing, but like legitimately, we want to get going. Sure. And what kind of advice can you give a guy like me or other people out there that want to start jumping into multifamily right now?
I mean, Jay and Brian gave some outstanding advice. I totally agree with everything they said. I think the only thing I would add is, yes, you want to be careful. Yes, you want to do your homework. You want to learn as much as you can. You want to try to get around people who've done it and learn from them. Consider partnering, but don't overdo it, right? There's the analysis paralysis, or you can spend so much time and have so much fear and so much caution that you never actually get started. And so I just would say, like, I want to supplement all the warnings with a big healthy dose of encouragement to go ahead and dive in and do something. Don't do it blindly. Find people that can guide you and learn what you need to learn, but don't make that a lifetime project, right? I mean, at some point you just need to buck up and take a leap, and you might fail, you might land on your face and get hurt, but guess what? It happens to all of us all the time. So you pick yourself up, dust yourself off, and you do it again. So that's probably the biggest difference that I see between people who are thinking about doing it, say, I'm just trying to get started, I want to be a real estate investor. The ones that actually make it are the ones that actually, buck up and actually do something. So.
All right. So.
And don't let ego get in your way. I mean, literally 18 months ago, I went to the person that's running the team that I'm doing a syndication with, and I said, let me work for you for free. Teach me this business. And I've done hundreds of deals. I've been doing this for 10 years, but I know when I know nothing, and there's no shame in going and saying, teach me and let me work this off. Let me work for free. So anybody that wants to do that, go find somebody that's doing it and volunteer your time in exchange for knowledge and experience.
But I want to add one caveat, because you and I know this, Jay. We get offered a lot of people to come, like, I'll do whatever you ask. Like, I'll just teach me everything you got. My advice to anybody that's doing that, know what you can give, not just your time, right? Because you just say, I'll give all my time to you. Well, what am I going to do with you, right? Like, so if you're going to say, hey, mentor me, show me, I'll work for you for free. Here's what I can do to possibly benefit your business in some way. So
save me time, don't take more of it.
Yeah. And so it's that you might get some ears pricked. Actually, you guys can't see him right now, but Alex Shower, whatever. Alex Shower, he's hidden. He's our co-host on the webinar right now. Alex came and seeked me out at one of our events that we do at local meetups here. And he saw the videos we're making for Bigger Pockets and all sorts of things. Like, he guys specializes in videography. He made that video you guys just saw on the PNW Expo. And he's like, can I help you guys make videos better? And I could provide that for you, work with you, all that kind of stuff. And he basically offered it for free. In return, he wanted to learn more about real estate and hang around us and be our shadow and all that kind of stuff. And he's been with us now since almost like a year now, if I remember correctly, but it's been a while. So, and I was like, yeah, sure, cool. We'll abuse you. I mean, we'll work with you. And, I mean, but in reality, there's a mutual benefit there for somebody to do that. And so he provided value, we provide value back, and it all works out. Now we consider him an actual team member to our team. So, and he gets paid every now and then. So, but anyways, so let's switch now into a few more nuts and bolts stuff. One of the things that I always hear about multifamily is value add, right? Like if I go to a multifamily seminar, if I read books on multifamily, if I do whatever, it's buy a C class and make it a B class or A class or whatever, or buy something that you can raise rents, kick out all the bad tenants, turn their units, raise the rents, continue to go. And in which case you make the property worth more because the NOI, net operating income, grows and the cap rates associated with it. And then you can refinance, get all your money out of it and have no money into it. And now you own this property with no money in it and you pay off all your investors and you're rich, right? So today, right, with rent growth sometimes being a challenge, because I know in my local area, we can't raise rents right now. And also evictions and so forth. Should people still be looking at value add properties right now for potential for their apartments or C-class properties like they tell us to go buy or in these courses? Brian Burke, I know you have an opinion on that.
I do. My personal opinion is that the B-class properties are going to be the shining star of the multifamily class. I think A's are going to suffer a little bit from new product coming on the market, new construction that's offering concessions and free rent to get lease ups. That's going to be a little bit of a drag on Class A rents. Class C is going to be impacted most heavily by rent defaults, skips, evictions, just non-payment issues. Class B is going to be kind of stuck in the middle where they get the benefit of some cost-conscious move-down tenants moving out of a little bit more expensive A into a B, and not have as steep of collection issues as the C class does. So I really believe in a B class right now. If you can find a C class that you can reposition to a B, that might be a strategy that you could put into play. I also feel a little bit right now that people are valuing affordability over amenities. And therefore, when I look at a new acquisition now, I'm not assuming I'm going to go in there day one, start doing renovations, increasing rents, and doing the normal plan we might have done on an acquisition even 6 or 8 months ago. Instead, I'm looking at it with a little bit more long-term horizon where we just operated exactly the way it is. We're using in-place rents for 2 years until we start coming out of this COVID nightmare. And then we institute our renovation plan and try to aspire to be like the nicer property down the street or the one next door. But in the meantime, we could be maybe the low-cost leader, the more affordable option, that sort of thing. So I think delaying your renovation plan makes more sense. What used to be a 2 to 3 year hold is probably now going to be a 3 to 5 year hold on a good day. And you just have to buckle up and plan for a little bit longer business plan.
I think it's also important to one of the things that you mentioned at the same time is that like in those C class or even less properties, certain cities have eviction moratoriums and they're continuing to go on as well. And that might affect when you're purchasing or even your property you're holding right now. Or on an acquisition side, you might have a landlord that's just like, I'm sick. I was already sick of this property. Now I'm even more sick of it because I can't evict these people. So there might be a motivated seller there. I know here in Seattle, there's an eviction moratorium right now that says it ends at a certain date. Well, they're jerks because as soon as that ends, our new winter eviction moratorium that came out like a year or two ago starts, right? So we really can't even evict people out of Seattle until I think like April at this point right now, no matter what happens in COVID world whatsoever. So but to that point, people should probably pay attention to the local landlord laws, like Brian Murray, you mentioned that previously as far as acquisitions are concerned too. So
I should say too, I mean, while that was a concern, I mean, I feel very, I love C-class housing. I love workforce housing. I kind of look at it like I agree completely with what Brian said as well. You know, with C class, if you can raise that up to a B class and reposition, that's great. But you know, you historically, what you'll see is when you hit those bumps in the road, you know, the A class might drop to B, B to C. Where do the C class residents go? Where's workforce housing go? Right there, that's the most affordable housing that's out there, and that's part of why we love mobile home parks. You know, we'll do with value add for that. We handle that a little differently. We do a lot of infill, filling vacant pads, and that's been very helpful for us. But kind of back to your original question about, you know, the whole value add. You know, I feel like it's important to mention that there's a lot more potential value add to most multifamily properties than just repositioning, right? So value add is all about driving up your NOI. So that can mean increasing your income or decreasing your expenses. And there's, you know, of course you can go into a 200 unit apartment complex and raise it from a B to an A or a C to a B, but you can also go into a duplex or a quad or any other property and closely look at opportunities to cut expenses and boost income. And that's how you can raise the value of those properties. And for the vast majority of people that are tuning in, I think when they're looking at properties, value add is more important in an environment like this than it ever was before. And when I first started with my investing back in 2007, you know, it was all about value add. I mean, there were in the markets that I was in at the time, there was no rent growth, right? So I relied heavily on value add, and it's probably one of the number one ways that I was able to grow my portfolio was through value add. And so I think anybody who's planning to invest right now, whether they're new or they're experienced, like dive in and look for those value add opportunities, look for ways to cut expenses, be creative, talk to other people who've done it. And there's a lot of opportunity to boost value without relying on rent growth.
Yeah. And if I could just add real quick, Brian Murray just hit the nail on the head. I mean, value add, for those that don't really understand the concept, it's essentially house flipping on steroids. When you flip single family houses or any small number of units, you're generally relying on physical renovations. When you're doing it for large income producing properties, when you're not selling to a homeowner, when you're selling to an investor, it's a combination of physical renovations and management renovations or efficiencies. And just like Brian Burke said, these days, if you're going to buy a value add, you might have to expect to wait a year or 2 years to be able to do a lot of those physical renovations because it might be hard to find contractors. It might be hard to get into units because of COVID. But you can still, like Brian Murray said, you can still focus on those management efficiencies. You can still get your expenses down. You can still get your better management, more efficient management in place to improve your NOI, even if you're holding off a year or two to do your physical renovations. So one of the things that we were looking for when we ended up putting this complex under contract a month or two ago was we were looking for something that was relatively stabilized, where the entry cap rate was enough that we could get pretty close to being able to pay off our investors until we can do those physical renovations and where we can improve the value just with operational improvements. So anybody that's looking at units now, I wouldn't go in and look for something that's at 20 or 30 or 40% occupancy, because you may not be able to do all the physical renovations to get that occupancy up for another year or two. Focus on those complexes or those properties that have decent occupancy already and where you can actually make inroads on the operational efficiencies.
I think what you just said brought up like a really big concern of mine jumping into multifamily for myself. And I think other people brand new, like I have a lot of experience flipping houses, and we do have a lot of single family homes that we own and some very, very small multi, duplex, triplex, that kind of stuff. But I remember when we bought a duplex with 2 other single families on the same lot. So technically it was 4, but we split the lot and sold the 2 houses and then kept the duplex. But it had 2 tenants in it when we bought it. So we had 4 units total, right? 2 houses and then 1 duplex. The duplex had a tenant in it and the 2 houses had a tenant in it. Man, as a house flipper and somebody that just wants to renovate and go, the operational, like you said, like whatever intricacies or whatever it might be of having to manage a tenant, get rid of them if they're not, if they're bad or if they're good, give them notices, while working on the other properties. I'm like, this is a hell of a lot easier. These people just weren't here, right? And I could only imagine, like for myself, my current business systems, you know, flipping houses and all that kind of, and doing BRRRR strategy. Like I know if I was running it, if I was the operator, I would be gummed up if I had a 12 or 15 or 16 unit that was like half occupant. And I was like, can we just get rid of everybody out of here? Like, I don't know, you're not supposed to do that because some people are good people, right? And you can't just like kick them out, right?
But it's not just the logistics. It's the calculus behind, if I kick out somebody that's $300 a month under rent and I start renovating that unit, is it better to keep that person now and focus on a different unit first? Do I keep them for a year and keep the income coming in so that I have income that I can use to renovate other units? Or do I start kicking people out? I lose that income completely and then I have to renovate and backfill. It's not just the logistics of doing it. There's also, you have to create a business plan behind it. And you need for a lot of us, we need at least some cash flow coming in. That's part of the business plan. You don't want to raise all the money you're going to need for the first couple of years. You actually want to be generating cash flow as you're renovating. So
that sends it back home to me going like, all right, I need to partner with somebody that knows what the hell they're doing on anything that's mid to large multifamily, even for myself. Like, it's just, I know I'd probably mess it up, or I'd get bored with it, or lazy with it, or do something illegal that I'm not supposed to do, right? If I'm the one managing it. So, I mean, if I could do that, then probably somebody else might be the same way as me. I don't know.
Well, I'd love to ask Brian and Brian, what are your rules of thumb on how you handle renovation and existing tenants that have expiring leases? What's your general rules of thumb there?
I mean, that's kind of that's a great question, because, you know, I think there's a tendency, too much of a tendency, for people to look at it as a kind of a spreadsheet issue. And, you know, the challenge is that these are real people, right? So it might sound like a great plan, but you're signing up for a whole heck of a lot of drama. And sometimes, you know, there's a kind of an ethical moral issue here too. You've got tenants who are on fixed incomes. You know, they might be great people. They might have lived there for 20 years. And how are you going to handle that situation? Are you going to force them to leave their home? We have tried whenever possible to focus renovations on vacants, and when we do the rent raises, we do it in a way that's maybe more conservative, and that's a lot of that's driven out of the human factor, right? Yeah, I mean, there's no easy solution with that. I think it's just, I think you hit the nail on the head, Jay, that it's a lot more complicated than it seems like on the surface. But that's definitely one of those issues that people who haven't like been on the operations side and had to actually go and confront the tenants and deal with these situations might make decisions that when you actually go to put them into play aren't going to turn out so well.
One of the reasons I like large multifamily, because you know, in the field, in the markets where we're investing, you know, large multifamily in southern states, natural turnover is somewhere in the plus or minus 40% annual range. So if we look at a renovation with a 3-year time horizon, and we say, all right, in 3 years, we want to renovate every unit, just the natural turnover is going to create a vacancy in 75% to 80% of the units during that period of time. And you can stimulate vacancy when lease renewals come up by maybe you do an increase to halfway in between a renovated rate and a non-renovated rate. And if they stay, fine. If they move, then you've got another unit to renovate. And if you need to stimulate vacancy, you can be more aggressive on those, on the lease renewals. Generally, what we found is we don't have to be all that aggressive. Just the natural attrition will allow us to implement our plan.
So we're going to jump into some of the Q&A that the viewers, are asking right now. And since we're kind of on this topic already about, you know, value add, small multi, that kind of stuff to begin with, we'll jump with this first one from Susan. Brian M., that's Brian Murray. How can I add value to a duplex or a quadplex or fourplex? Like, how do you add value to that?
So,
there's a lot of ways, right?
Yeah, I mean, it's crazy. I'm working on a book right now where it's got a section on value add, and the number of ways it's so long. I mean, there's literally, you know, I've got well over 100 items that you can look at for value add. you know, you could look at anything from going from renting out a unit to switching to renting out rooms. You can convert, unusable space into like rentable storage space. You can take utilities and bill them back to the tenants if they're currently being paid by the landlord. I mean, it's hard to give, a full list on an answer in a Q&A session like this. Lot of opportunities for ancillary incomes as you get up into a few more units, that you're looking at things besides just the base rent. You can look at pet rent, pet fees, different types of amenities that you can, or services that you can offer your tenants. But it really is an exercise in creativity and in looking for efficiencies. And, the bottom line for us is we get the most excited about properties the worse they're managed. So when we see things that are not taken care of, if we're going to go and look at a property, if I was going to look at a duplex or a tri, I'd love it if I see everything just being a mess and not well taken care of. As long as it's structurally sound and the things are cosmetic, the numbers that you're buying on hopefully are based on poor management, and you can go in and you'll find if you look hard, you'll find opportunities to better manage expenses. Sometimes just putting things out, as simple as putting things out to bid that haven't been put out to bid in 5 years. And you can drive those expenses down, bringing your rents to market. Whether everybody thinks about rents being lower than market and you can raise them. We've gone into properties and realized that the high vacancy is because they were overcharging, and we've lowered rents and we've created value by lowering rents. So it's really specific to the property, but there's tons of ways you can go about that.
Awesome. Thank you. We're going to go to this question from Facebook Live on Bigger Pockets from Jeff Gagnon. Sorry, my name's Charlie Yarber. People screw up my name all the time, so I'm an excuse. So I guess this is going back. This question is specifically going back to when we were saying, go find a mentor, go work with people, go find, maybe somebody can be the operations or somebody that you can provide value to as somebody wanting to start out. How do you get around other investors when you're first starting and you bring little to the table? Like, how do you actually build that network, and how do you get in? How can somebody get in touch with us and hang out with us if they're not bringing a lot of value? Jay, you want to start with that one?
Sure. One, go to the PNW Big Badass Virtual Investor Conference. Sorry if I screwed that up. Okay. But seriously, it's funny. Everybody assumes that I know everybody in this industry and I'm friends with everybody in this industry and I can pick up the phone and call anybody. But the truth is I'm pretty much an introvert and I don't know a whole lot of people. And most of the interactions I get with other people like Brian and you are when I go to these types of events. So it's a great place to hang out because typically any of us that are there speaking are also there to network and to meet other people and to expand our networks. And, you guys know that when we go to these events, generally we'll also go out to dinners and lunches, and it's kind of like, hey, if you want to come along, and it's your opportunity to meet not just like big names like Brian Burke and Brian Murray, but to meet other people that are doing deals in either your market or around the country that are doing things that you're doing. And so attend those events and then attend local real estate investor meetups and then jump on Bigger Pockets and get involved in your local Bigger Pockets forum subgroups and invite those people out to lunch. I moved down to Florida last year, and one of the first things I did was I went on to Bigger Pockets and Facebook, and I said, hey, I'm going to be in this area this day. I have to meet some contractors and I have some time for lunch, and pizza's on me. And I had like 30 people come out, and one of those people ended up being a partner that I've now done about 24 deals with over the last year. So just put yourself out there and you'll meet these people and don't add value. That's the other thing. Add value.
Add value. I want to add one thing. Actually, I can tell you how not to do it, right? That sometimes is sometimes the better way to do it. What Jay's talking about too, like reach out to people on Bigger Pockets, right? Like there's he was just on the Bigger Pockets podcast, Elliott Smith, and him and his wife are just on it again. He's been on it twice. Great guy, great wife, great couple, great everything. They're just amazing people. I met him because of Bigger Pockets, because of what Jay just said. I was opening in Portland, and I sent out a Bigger Pockets post saying, I'm going to Portland. Anybody want to hang out and talk real estate? Elliott jumped on it. But Elliot, what he didn't do was write me a 6-page email about his entire life story and asking me a million questions and sympathy card or anything like that to try to get me to like him, right? Because we don't have time to read that. He just said, let's meet. And when he met, he would ask me 1 or 2 questions at a time. He'd feedback, like he'd be interested in what we're doing, right? And then he would bring value, right? He said, I'll drive your properties for you while you're not here in Portland. Right? I'm like, cool, right? And so he did that. And then he'd take some advice and he'd go use it and then come back, right? And if you see this with Brandon Turner actually at events, if you go to an event and you see Brandon Turner, he is surrounded by like 20 people, right? And it almost feels like they're like piranhas, like on him, and he's trapped in the corner and they're just like wanting to take. How now, if you wanted to become friends with a guy like Brandon Turner, right? Ask him about himself, provide value, be interested, right? In that sort of way. Maybe there's a way to make him laugh, right? Maybe it's just being people skills. Just be yourself, right? Don't be that awkward person, right? Jay and I became friends at an event. Brian Burke and I became friends at an event. Brian Murd and I became friends at an event, right? So we all became friends at an event. And Jay is correct. He is introverted. As soon as he became friends with me, he stopped talking to everybody else and just followed me and my group everywhere. So he didn't have to talk to everybody else. Like but it's true. So it's one way. Just be yourself. Don't do what I did. If you guys know who Jocko Willink is, he's one of my idols out there. I met him at a jiu-jitsu tournament or a jiu-jitsu camp, and I was the super awkward fanboy for the first time in my life, and I thought I'd be super cool with him. Hi Jocko, can we? Like I was just so awkward, and it was the most embarrassing thing in my life. I'm sure he thinks about it all the time, but we're not friends because I was the awkward fanboy that just wanted to like talk to him about awkward stuff, right? So don't do that. But anyway. All right, sorry, we jumped on that topic too long. So another good question. Let's go to the QA board. I liked this question this guy asked as we're starting to wrap up too. Just because I'm curious what you guys have to say about this. Because Grant Cardone, let's talk about Grant Cardone for a second. So this guy's asked a question. Jordan, Grant Cardone is famous for saying that he should have purchased every 4-cap multifamily building that he could have back in 08-09 crisis because he would have made a ton of money regardless of the in-place cap rate. What is your opinion on this strategy today and over the next few years, given where interest rates are?
Sorry, I stopped listening at Grant Cardone. I'll let one of those other guys answer.
Brian Murray.
Yeah, I don't know what to say about that. I mean, that's hindsight 2020, right? So I don't think that it would have been a well-advised investment strategy at the time. And so you can't be critical of people who didn't do that. You look back, anybody can look backwards and say, yeah, I should have bought under these circumstances because it would have worked out. None of us have that crystal ball to look forward and say with any degree of confidence that, hey, you should be scooping up all these properties right now because 10 years from now, you'll look back and wish you did. You very well may, but you very well may end up in bankruptcy. So, that's too broad of a statement for me to be comfortable with.
Let's not dive into it anymore then. All right. So I have to ask this question because one of our very cool, very good friends, one of my favorite people out there, Brittany Arneson. If you guys are on Instagram, follow Investor Brit. She does amazing Instagram stuff for real estate investing. She does a lot of DIY stuff. It's awesome. We love her to death, and she'll be at the PNW Real Estate Expo. She's asking, well, she says, this is super awesome, feeling motivated, and she's a motivated person. Also, I am super excited for the expo. Oh, great, thank you. Questions I need answering. So I have an off-market 8 unit I'm looking at. I heard it failed a phase 1 environmental in the past. Current owners bought it cash, so they don't have any mortgage on it. Don't really want to go through the hassle if I can't get it financed in the end. What are the first steps you do in this case? So basically, owners own it free and clear. It failed a first phase environmental. She doesn't want to go through all the hassle of, going through this whole thing if she can't get it financed later, right? Are there any, I guess if I had to clarify the question, Brittany, it has more to do with a property that's failed a first phase 5 environmental. Like, what do you do for financing purposes and going through all that stuff? Like, what are some suggestions on a property like that, I guess, if I had to clarify your question? Because for those of you guys listening, most banks aren't going to lend on a property that fails an environmental or phase 1.
I'd start by getting a new phase 1. See what the problem is, quantify what the issue is, and then sometimes you just have to get a phase 2, and then it can be solved through the inspections in the phase 2. But the only way to find out is to kind of go through the motions and see what the environmental stuff is so specific. There's no one broad stroke answer. You really have to define what the issue is, and then drill down on how it can be mitigated.
Yeah, I would add to just start off by making sure you get a copy of the phase one that was already done and looking at the specific reasons why it failed. And ask the owner how that has been addressed and whether or not it's been addressed. If it hasn't been addressed, it's probably not going to clear again. If you can't get a phase one, it's not going to get financed. So if they give you a copy of the phase one, you know, and you have reason to believe that it could clear the next test, then you put it under contract contingent on the results of a new phase one. So, hey, Brittany.
Hi, Brittany. We all love you. I guess that's similar. I mean, like when I hear you guys say that sounds similar to a single family that you get an inspection on and a bank won't lend on it. So like if I'm selling one of my flips and it doesn't have a stove, right? Most banks aren't going to lend on it unless it has a stove, right? Because it's simple housing situation you got to have, or smoke detectors or CO detectors. So it's okay, you get that, and then you go solve it, and then all of a sudden the bank will lend on it, right? Similar to that. Is that what I heard? Okay, just making sure because I've never had an environmental done. So let's go to Reza on the questions. So his question is specifically geared towards basically people telecommuting. So what do you see with the new corporate telework policy? Basically, a lot of corporations are allowing their employees to telecommute and downsizing of office buildings. What do you guys see that effect on the markets for basically a lot of commercial property not being there, or a lot of corporations allowing their employees to work from home? How do you see that affecting the market?
I would say we own some office buildings and retail properties, and I would say that I share that fear. I think it's going to have a pretty significant effect on that sector of commercial real estate. In terms of multifamily, you know, you may see more growth in some of the secondary and tertiary markets as people are less dependent on location for their work. I think that would be a long-term trend. The other thing I expect to see is that more apartment communities will offer, you know, office type of maybe co-working, or maybe, you know, a bit of an office resource type place within the community will become a more popular amenity.
Anything you want to add, Jay or Brian?
The other thing we've done is we have a 2-bedroom apartment. You can market it as a 1-bedroom with an office too, and that's been effective. I mean, some people will actually, you know, they'll if you market it both ways, you can sometimes get renters that way.
Well, on a fun note, I just realized my dog's been in my office this whole time. I didn't realize that. I thought he was outside with his mom. So I might have to let him out here in a second. But for those of you guys watching, if you're listening to this on the recording, you can stare at your speaker right now and you can see my dog, right? All right, so next question. Let's jump into that right now. All right, let's go to this one. Mike Hughes, you guys talked about it slightly a little bit, but let's see if you have any more input on it. When purchasing small multifamily with long-term tenants paying low rent, as he shows, and deferred maintenance, how do you handle rent increase and notice of vacates in a rent-controlled market? Is that even possible? And Brian, you invest in New York, so that's rent-controlled market. I guess.
Yeah, the rent control is specific to New York City, and we don't have properties within the city. So, you know, I don't have any properties right now in a rent control market.
Got it.
Me neither, and I never will. So I can't be a resource on how to answer that question.
Fair enough. Well, man, let's get rid of the rent control part, right? Any advice on how to handle rent increases and notice of vacates on a tenant that's paying really low rent on a property that has extreme deferred maintenance? There you go.
Have a discussion with them. So, I mean, again, Brian Murray said this earlier about how there's a human factor here. And especially for smaller units, it's not difficult to actually go in and have coffee and donuts with your tenants and say, hey, look, what can we work out here? I want to raise rents, and you will probably want a nicer living conditions. What can we negotiate here that will be beneficial for both sides? And then put a plan in place. Maybe it's small rent increases over several years. Maybe it's a moving to a different unit while you renovate theirs. I mean, there's lots of ways you can go, but like Brian Murray said, it's at this point, it's not a spreadsheet issue. It's not a spreadsheet problem. It's a human problem. Unless there's some business plan you need to execute on, in which case you need to decide if it's worth dealing with having to evict somebody just to execute a business plan.
All right. So we've been going on for 75 minutes, and I want to sit there and start wrapping up with one last question from each of the panelists. And don't forget to go to pnwrealestateexpo.com or badassexpo.com. It goes to the same place, or Badass Real Estate Expo. I can't remember. Anyway, go to pnwrealestateexpo.com, and you guys can talk to these guys more there for sure. So last question, and we will start with Brian Murray. Now, for those people that are starting out or advanced, and you're talking about currently right now in multifamily market today, what advice can you give people what best advice can you give people to not do specifically right now in real estate multifamily?
You know, I think that there's just this tendency for people to say, I just want to ride it out. And I just think that there's a lot of opportunity right now. So I think people should be making moves. And there's just a number of different ways that can play out. I mentioned earlier that lending rates are at historical all-time lows right now. Unbelievable the kind of opportunity that presents in terms of, we're aggressively refinancing properties right now. We have even had luck going directly to the banks and asking for loan modifications. We'll go into the bank and say, listen, rates have dropped enough. We need to refinance this property, especially for local or regional banks like portfolio lenders. If you go, we've had 4 loans where we successfully gone to the bank and said, we really don't want to put this back out, refinance it. You modify our rates and drop our rates, and they've agreed to drop the rates. Other ones we put out refinanced. And so, look at your debt. This is you're never going to have a chance, very unlikely, as never say never, but you're unlikely to have a chance to get capital at the rates you can lock in today long-term. And that's an opportunity. Look for good opportunities to buy, maybe selectively, part with marginal properties. But to me, this is a time to act, not to sit back.
So Jay Scott, what best advice can you give for people in multifamily and what not to do right now in today's market?
I'll give the same advice I give for single family and any other kind of family or non-family. Be conservative. Right now, we don't know exactly where the market's headed. And so anytime I'm going to buy a deal, again, whether it's single family, multifamily, commercial, whatever, I ask myself, what's the most likely things to go wrong, and how do I mitigate those particular issues if they do happen? And if I'm comfortable with my mitigation plans, and if I'm comfortable with the risk of those things potentially happening, I move forward with the deal. If I'm not comfortable with the risk, or if I'm not comfortable with my potential to mitigate, I say now's not the right time. So it's always a good time to buy real estate, but sometimes you have to be more conservative. Sometimes you have to have better plans in place, have a plan B, a plan C, a plan D, exit strategy for anything you buy, because who knows where things are headed in the next 6 to 12 months.
Perfect. And last but not least, Mr. Brian Burke.
Well, Brian and Jay gave great advice, both of them, on some good things not to do and to do as well. I would say that the one thing I can add to that is don't over leverage. Having survived multiple market cycles in my career and looking back on those and thinking about how I survived and what happened to the people that didn't survive, i.e. the ones I was buying from, the ones that ran into trouble were the ones that were over levered. And, if you can be very conservative in how much you borrow, it gives yourself some margin of safety to be able to ride out declines in income and adverse economic cycles.
That was going to be the last question, but I got to ask one more now. So and this actually, you're touching on something that I've always been curious about. what is the measure of being over leveraged, right? And because, in single family, most banks won't lend to you more than 75, 80% LTV, right? If it's an investment property to begin with. So is taking that over leveraging all the way up to that, or in multifamily, is it different? Or at what point do I think that I'm over leveraging?
Well, it's different in all sorts of aspects depending upon, what you're doing. In the great foreclosure crisis, the debacle was created by over leveraged homeowners who were borrowing 100% to value with negative amortization that was increasing their loan balance every single month. That was a definition of over levered. Another definition is when I would have people come up to me and say, I've got to buy a rental house and it's 2005. And I'm like, okay, the house is $500,000 and it rents for $1,500 a month. How do those numbers make sense? But they would still go do it with 80% financing, and they were in negative cash flow. So negative cash flow is a really risky place to be. If you can afford it and you have other income that is rock solid, maybe you can ride out negative cash flow. But if you own 10 properties or 20 properties and they all turn negative, then what are you going to do? So positive cash flow is another measure. Loan to value is yet another. I would think today I wouldn't want to borrow more than 75% of the total cost of the property, which would be acquisition price plus rehab. I'd much rather be at 70% of the acquisition price, or even better yet, 70% of the acquisition price. In fact, a lot of stuff we're underwriting now, we're looking to borrow 65% of the acquisition price and have the rest as equity. The primary driver behind a lot of this is a measurement that most people don't use and many people don't know about. And if you don't know how to calculate it, you can Google the term or you can buy my book. Either way, and you'll find the definition is default ratio. And what default ratio is telling you is how much can your income decline before you hit a 1-to-1. In other words, you go into a negative cash flow. So a default ratio of 85% would mean you can withstand a 15% decline in income before you hit negative cash flow. I wouldn't want to be into anything that has less than or greater than an 85% default ratio.
Tarl, I would add to that I think it's dangerous for people to track their exposure using LTV. And that's because it's the V in there that's the problem, right? So we don't know where cap rates are going to be, and that equity can disappear really fast. So I would agree with Brian's assessment. I would add in there that debt service coverage should be something that you're looking really closely at. I would rather have a high debt service coverage ratio, meaning that cushion that the property can clear your debt payment, than to have a lot of equity. Because it's somewhat arbitrary how you're coming up with that amount of equity.
Yeah, I mean, that makes, on a single family level, that makes a ton of sense to me just mentally when it comes to lending. Because like right now we're refinancing a lot of our rentals and so forth. And like one of our properties we bought in November, we priced it as is Tacoma. We priced it as an ARV that would be like 280 by the time we're done with the after repair value, fully fix it up and so forth, and then refinance it later. The appraisal just came back and it appraised for 365, right? And I'm like, sweet, we could take out way more money, right? But then the max LTV for the lender we're using is 80%, but they have a strict debt service ratio of a 1.25 debt service ratio, which I'm like, man, why is that so high? Why can't it be like whatever? So but to that point, a lot of other investors think that some way. Like what lender has a 1.0 debt service ratio that allows us to do that and it gets an 80% LTV? That's the best lender you want to take. But that might not be the case, right? And it might not be the best case right now specifically to begin with from what I'm hearing from you. So excellent points. And because I want to borrow as much as you can, right? No. All right, cool. Especially multifamily. All right, so that said, I want to thank you guys once again for being on this panel. For those of you guys that just tuned in or coming to the party late, Brian Murray, how can people get a hold of you?
I could reach me through social media, Instagram at Crushing It Brian.
Crushing It Brian.
Facebook, LinkedIn, any of those are good.
I'm going to plug Brittany. Investor Britt's the one that started his Instagram page for him and put him as Crushing It Brian. So thank you, Investor Britt. Brian Burke, how can people get in touch with you?
Well, either through our website, praxcap.com, it's praxcap.com, or Bigger Pockets, or Instagram, because Investor Britt also started my Instagram page, or at least Brandon Turner is the one that showed me how to use Instagram. And then Britt said, you can't use a name like that. You've got to change this name. So at Investor Brian Burke on Instagram.
Awesome. And if you want a cell phone, we'll put it on the show notes later. No, I'm joking. And then of course, Jay Scott.
I'm sorry. I'm busy texting Britt to find out why she hasn't offered to help me with my Instagram page.
Yeah.
Jeez, I feel so left out. Britt, come on. No. So if you want to reach me, I am on Facebook and Instagram, jscott_123flip at Instagram, jscottinvestor at Facebook, website jscott.com or 123flip.com. And I will give out my email if anybody actually wants to email me, j@jscott.com.
j@jscott.com. Got it. All right, guys. And of course, I'm Tarl Yarber with Fixated Real Estate. You can follow me on Instagram at Tarl Yarber. I'm the only one there, so you guys can find me. Pretty straightforward company, Fixated Real Estate at FixatedRE. We'll see you guys at the PNW Real Estate Expo, the virtual Big Badass Real Estate Wealth Expo. Go to pnwrealestateexpo.com. You can talk to those guys then. When you guys buy your tickets, in a little while, we'll be launching our virtual app so people can actually start networking before the event even starts. It's going to be awesome. So we'll see you guys there. And next week, tune in once again. We'll be putting out a blast out for the next week's Experts Live. And you'll have a new panel with a new topic. And we'll see you guys next week at noon on Wednesday Pacific Standard Time. Thanks again, guys. Bye.